The tussle with inflation has forced the Reserve Bank of Australia to make some significant changes. Today, we're going to run through everything you need to know and what it means for home buyers out there. Jaden, let's start off on the top and talk about Westpac's recent prediction.
Yeah, big news is other rates going up, other rates going down. It's obviously impacting a lot of people's decisions. Should you buy? Should you wait for the rates to come down? Bill Evans, Westpac's chief economist, has predicted the next move by the Reserve Bank is going to be potentially down. He's saying that he's predicting a rate cut instead of a rate rise. So, we've actually seen over 4% increase in rates since May 2022 to combat the recent inflation issues that we've had. It's obviously a global issue, but Bill Evans is saying, barring some unexpectedly strong, if people start spending massively over Christmas, it's going to change this. But he's saying, based on the latest inflation data, he's saying potentially that there's not going to be a rate rise like other banks are saying, and they can actually cut.
Yeah, and we've seen this as inflation stands currently at 6%, which is well above the Reserve Bank's target of 2 to 3%, and the jobless rate's nearly at a 5-year decade low at 3.5%. The Reserve Bank is projecting that there's potentially a little bit of comfort that they're okay with inflation coming back down to their expected target until December of 2025. So they're actually finding that they're not in as much as a rush as their peers across in different nations.
And it's a weird thing with the Reserve Bank that they're trying to trend. They're saying, well, potentially we need the jobless rates to go up so less people need to be employed, so people are spending less. But then it affects the economy because they don't want us to go into recession where things go backwards really quick. There's massive job losses and issues there. So it's a bit of a tightrope they're walking at the moment, but doing a pretty good job.
That's exactly right. And there are lags. So with the cash rate, we've seen 12 increases over the last 13, 14 months. And there's talks that it takes about 12 to 18 months for those rate hikes to permeate through the economy. So the Reserve Bank's made a lot of changes in a very short period of time. And that's where Bill Evans is sort of saying, well, maybe there's already been enough tightening happening that the Reserve Bank's job is nearly done. So it's going to be interesting to see how that happens. The impact of the rate rises will also be compounded because there was a lot of people that took ultra low fixed rates during the pandemic, and these fixed rates are starting to come off. And if you are finding value in our videos, please consider hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. Jaden, talk to me about these fixed rates ending.
So there's about 880,000 fixed rates that are finishing this calendar year, with another 450,000 facilities ending before 2025. So there's actually a lot of people coming off that have gone from 2% to 6% at the moment. There's also been a lot of home buyers that have bought in the last 12 months and have felt the brunt of those 12 rate rises that have come through and feeling a bit pinched. So interestingly, in Australia's interest rate environment, it's very different to America, and people will throw the comparison. We'll look at what's happening in America, what's happening in the UK. In America, structurally, it's different. You'll have a fixed rate for 25 to 30 years, and you're not going to feel these cash adjustments that are coming through. In Australia, however, the majority of people outside the pandemic go for a variable rate. So they're going to be feeling it much more, and it's going to be transmitted to the economy much quicker than it has overseas.
And even with our fixed rates here, typically the maximum you can fix in for is 5 years. Most people usually opting for a 2-year fixed rate. So there are some significant differences. And that's where the Reserve Bank is starting to see the effect of their rate rises. Inflation fell to 6% in June from 7% in March as consumers are reducing their discretionary spending. We've also seen demand declining, and that's seen household demand leading the longest downturn since in the retail sector we've seen in a long time. With the ultra high interest rates and material costs, the construction side is also having massive declines. There's been a 34% decline in construction, and that's since the peak of 2021.
Yeah, we've seen a lot of drop off in construction. It's been pretty well covered across the media. Builders are going broke at higher pace than ever because they've been squeezed. They typically will have a fixed price contract. So 4 or 5 years ago, it'd be common to go buy a block of land, get a fixed price contract with Metricon, and they said, yep, it's going to be $300,000 to build this beautiful brand new home. We won't change that price of the contract. But fast forward during the pandemic, the price of timber, concrete, things like that were going up, 7-8% with the inflation a quarter. It was crazy. It was going out of hand. And these builders weren't able to keep that fixed price contract, got to the end, and had to fold. So we are seeing that. If you are considering build, we're getting a lot more inquiry about that at the moment. I'd really strongly suggest you don't go in there with the minimum deposit. If you've got the minimum deposit, you want to have a bit of contingency, a bit of buffer money, just because these costs can blow out. And if your construction gets delayed, the costs go up further, you got more holding costs, it can be a bit of a recipe for disaster.
We're also seeing growth slow. So GDP is expected to slow by about 1% by the year's end, making it the slowest annual rate change in over 3 decades pre-pandemic. Now, unemployment rate also remains at a 50-year low at 3.5%, and wages are growing at the fastest rate in the past decade. And this is due to the imbalance between labor supply and demand. There's also indications that the job market may soon be impacted by high interest rates, with the Reserve Bank forecasting unemployment to hit 4.4% by 2024. And job advertisements have actually fallen the fastest since 2022, suggesting that there's a possible slowdown in the market for labor coming through.
And you can see how this can have an impact, because for businesses, if they've got any debt, any loans, they might own property, all sorts of things, it's costing them more to have that loan and that lending. It's potentially costing them more for staff. So they're saying, well, we're going to potentially have to hire less people, try and get the benefit of technology, and it's slowing things down. So it's sort of working the way the Reserve Bank's wanting things to go. But as I said earlier, it's a real tightrope, because if unemployment shoots up massively, the economy grinds to a halt, they have to cut rates pretty quickly to sort of spur the growth. So it's a bit of back and forth game.
And that's where we're seeing the Westpac Melbourne Institute of Sentiment survey showing that household unemployment expectations have actually risen by 32% due to the Reserve Bank's lifting interest rates since May of 2022. Now, what about young households, Jaden? We're seeing that there is a massive affordability crisis. Let's talk a little bit more about that.
Yeah, so it's obviously hard in places like Sydney, where property prices, or they came back a little bit, have kind of bounced back, and there's even calls that there could be further growth this year. So what we are seeing is a bit of a shift in the people that can actually afford to buy homes, in particular in Sydney. So new research has actually shown that the Sydney population, particularly for people in their 30s, is declining. There's less people able to buy, so they're looking to move elsewhere in that 30 to 40-year-old demographic.
Now, PropTrack's latest data forecasts that Sydney prices have actually grown by 3 to 6%, and the population decline in Sydney has been over the past 20 years. Sydney's lost approximately 0.5 of its population due to high property prices, and these individuals are moving to regional areas and other capital cities. The population size has maintained primarily due to international migration, and that seems to be the trend in Sydney. The internationals move into Sydney, and then the locals seem to move to Brisbane and regional areas like Newcastle. Jen, what are the main age group of these people looking to move out of Sydney, particularly because of the affordability crisis?
So the biggest outflows are people in their 30s, 40s, and 60s. So the first two groups is probably likely because they're going to need bigger homes for their families. If you're in your 60s, you're probably retiring or looking for a bit of a lifestyle change. But from what the survey says, a lot of people are leaving Sydney and opting for, especially during the pandemic, looking at Newcastle, Wollongong, where you could still potentially commute, but still get a home for a place like that. Otherwise, we've seen a lot of people move interstate. A lot of migration to Brisbane, Adelaide, Perth. Some of those have seen people move out of Sydney and there to where it's more affordable.
Now, interestingly, this trend hasn't been happening in other cities like Brisbane, Canberra, and Perth. So the outflows is specifically for domestic outflows is more specific to Sydney, and that's mainly due to the cost of housing there, and it's the affordability crisis that they're having.
So there's potentially a big change on the horizon for the interest rate forecast. At the moment, the fixed rates for the 1 and 2 years are still saying things are going to go up, but Bill Evans is saying the contrary. What do you think? Are you expecting rates to go up? Are you planning for 7-8% interest rates? Do you think they're going to come down?
And do you know, here at Hunter Galloway, we're a mortgage broker and deal with people Australia-wide. If you're a first homeowner needing assistance, we can help. Reach out with us at huntergalloway.com.au, fill in a contact form, or call us directly on 1300 088 065, and we'll see you next time.